Hey, welcome back to The Market Investor. I'm Daniel Snyder. Thank you so much for checking out this video. It's another interview with Boomer. He's gonna drop a lot of good information about mutual funds, index funds, how much you should be putting into them, and how much are the costs associated with them, everything that you need to know to get started. So let's cue up the intro and let's play it. Boomer, thanks for joining us today. How's Atlantiville?
Atlanta's pretty good. Coming down with the corona pretty good. I'm outside of it now, so hopefully gonna avoid that.
Yeah, man.
But trying to stay safe. You know how it is. How's LA?
Dude, LA, I mean, everybody's wearing masks, right? We actually just ordered a mask yesterday. So I've been using a bandana before that, but it's just weird going to the grocery store and like everybody's wearing masks and you're like, you know, pre-coronavirus, you wore a mask in a store, you were robbing the store. So it's a bit different, right? It's a bit different.
It's legal here now to do that.
Yeah. So let's just dive in, man. I want to
Sure.
kind of pick your mind. I know it's been a little bit of time since we did the last interview. What are you watching in the market right now? Like, what is your focus? What stocks, companies, or just economic movement are you looking at?
So I'm kind of studying a little bit of everything. I've kind of diversified my portfolio a little bit to get a little more into tech and services. A recent buy is Delta.
Same.
Price is way down from what it usually is. It's about a third of where it was consistently staying for, past few years. So even if it starts to dip a little bit, I think it's going to be a long-term investment. And it's already kind of paying out today. So hoping that's going to stay there. Another buy recently did was CVS. I think through this whole pandemic, they're going to be able to, help a lot of people. And long-term, I think it's just a good company to have. So kind of just watching goods and services that are valued way lower than they usually are, playing the long-term game and hoping for, some results. Even if it's not this year, I'd imagine that they're going to, bounce back within the next couple of years.
You said tech. What tech are you watching?
So I'm heavily invested in some mutual funds, focusing on select medical devices. Technical medical devices like biotech and stuff like that. I think with a lot of hospitals reaching out to pretty much any research and development firm that is able to come up with COVID testing more quickly, I think they're going to be pumping money into that as long as possible. So I think that industry is going to go up a little bit, or at least stay steady during this time. And then just kind of IT and services in general. So Apple's always on the watch list. Microsoft are always the big two, but just kind of sticking to that for right now.
Yeah, man. And that's a good setup too, because today we're talking about mutual funds, index funds, what they are, why you should hold them, which one you might have in your portfolio. So good setup. That was smart.
Thanks, man.
Yeah.
It's weird.
It's like you've done this before or something.
It's like you told me what to say.
Oh my God, here we go. So first things first, let's do number one. What is a mutual fund?
So mutual fund is, picture it as something that's made up of a collection of stocks and bonds that follow a certain index to give you your desired result. So there's a few different kind of mutual funds that you can buy into, which I think most people are familiar with the index fund, which is really just a makeup of stocks and bonds that follow, whether it's like the Dow Jones Industrial trend, it'll pretty much follow that completely. There's an S&P 500. I think a lot of people are invested in the SPAXX fund, SPAX, which really just follows the S&P down to like the point pretty much every day. So those are usually fairly cheap, don't require, a buy-in price, and the cost of keeping it is pretty low. It's usually less than 0.05% per year. So people find that pretty attractive.
So we're talking about a mutual fund is kind of like Well, for instance, an index fund, right? It's kind of like the burrito, if you will, right? All the various weightings of various stocks are put into this fund, and like you were talking about matching the S&P 500, right? So the S&P 500 is made up of roughly 500 companies that are all weighted a certain percentage point that make up the entire index. And so what these guys are doing, these portfolio managers or whoever creates the fund, is looking at what the index is made of and then literally just buying the same equivalent of stock in these companies inside the fund, right?
Exactly. So they pretty much make up or will buy into a certain amount of stocks and bonds that will pretty much be a mirror image of how the SPA or the S&P is going to be moving. So it's not really like a high frills, high risk type thing. It's really if you're not too invested in the market and you just want to have something that's going to steadily stay the way that the market's going, then, it's your perfect option to buy into right out the gate.
Right. So it's like a 1.0 beta.
Exactly.
So walk me through, you mentioned to me earlier today, select market mutual fund. Now I don't know what this is. So would you be able to just clarify on that, what it is?
Sure. So as opposed to an index fund, a select mutual fund will follow a certain industry that you want to buy into. So say you are interested in software and IT, and you're looking to purchase, a lot of Apple and a lot of Microsoft and, other IT tech companies, but you don't really know where to start. There's usually a mutual fund that can follow that industry to the T. That, if tech in general is going to go up, then your mutual fund is going to go up. So what these fund managers do is that they will pretty much buy a collection of stocks and bonds that are of software and IT companies, put it in this mutual fund that you can buy into, and then you buy certain shares of that. And then whenever those companies in that industry is going to do well, that's when, the mutual fund will go up. And you kind of see an increase in the same way that the stocks will increase. So instead of, putting your whole portfolio into just Apple stock, you can kind of hedge your bets that if, one tech company goes down and another one goes up, then your mutual fund, will find that balance. And then more often than not, if they're all doing really well, then your mutual fund will, continually go up until something else happens.
So we're talking low risk, low reward though, right?
Not necessarily. So it's less risky than buying into a stock itself. So in that aspect, it's a little less risky. But as opposed to an index fund, there's a little bit more risk that goes into that. But as long as you're in a bullish market, there's going to be more reward that comes with it as well.
But we're no longer in a bullish market. So what do people do now? I mean, do they just avoid these select market, which it almost sounds like they should be called select industry mutual funds, in my opinion. Like if I'm only focusing on consumer staples or only focusing on tech or only, focusing on healthcare, like I think of it more of an industry. So, we ended the bull market, right? This last few months with coronavirus and everything going on, we're in a bear market. We're still down 20%, over 20%, right? And like, granted, we're over 30% off the lows, right? So that like poses a whole new question of, was the bottom actually the bottom? And like a lot of people are like, yeah, that was the bottom. Like we're on the way back because we bounced up off of the bottom so high. And every time throughout history, from what I've been reading, is once you break that 30% threshold, you never go down and retest the lows, which is why people's mind shifts are changing right now. But so in a bearish market, do I avoid a select market mutual fund?
I guess it kind of depends on your willingness to hold it long term. So at least with trends that you're mentioning, like even if there's a bearish market at the time, and you have money that you want to put into the market to get interest and dividends long term, then there's not really a bad time to buy into a mutual fund. So this is more of the investor's way of buying and holding for a long period of time, knowing that the market always trends upward at one point or another, and just holding it for as long as you're willing and able to see it grow. So it's not more for the day trader. It's more for somebody that has, IRA, 401k are pretty much only made up of mutual funds. So this is something that, people with these retirement accounts want to keep long term. If you aren't as savvy with the market and don't want to do active trading, mutual funds are also the way to go for it, because you pretty much have to hold it for 90 days as like a minimum. So that's something that you also have to take into account, that if a certain industry is going to go up within the next 30 days, but you're not willing to hold it past that 90-day period and fears that it's going to go down, then this isn't necessarily something that you want to get into.
Oh, that's interesting.
So that's kind of where this could be another discussion. But if you don't want to buy into the specific stock and then trade it quickly because your fear is that the stock may go down, but the industry could go up, that's where you could get into, ETFs, which are pretty much miniature mutual funds.
Right.
That you can buy and sell like a stock.
Like a stock, yeah.
Exactly.
So, and that's a good point. You said it's not for the active trader, right? Like I have a lot of friends that I'm helping with right now, especially because everybody's so interested into getting into the market right now. I have a friend of mine who just made $800 the other day, day trading, right? But these mutual funds aren't meant for the day trading mentality. So why do I want one in my portfolio rather than just going and buying stock?
Well, it's less risky than a stock. You're pretty much guaranteed to get interest and dividends as well. So the minimum that you usually have to do to buy into a mutual fund is also about $2,500 for a lot of these brokerages. So for stocks, usually you find some that's worth $100. You could buy into it pretty quick and do the active trading and try to gain a quicker profit. But if you're looking to get something long term, that you have to buy and hold for a long time, that will have compounding interest over time, and probably more dividends and higher dividend yields than these individual stocks are putting out, then that would be the reason to buy into something like this.
Yeah. No, I totally agree, man. I think everybody should own a mutual fund, or I love index funds, right? Like I want something that just wants to track that S&P 500 or whatever index you want to choose. But I'm a firm believer that you should at least have something that tracks the index to help build the foundation of your portfolio. So that even if you do take some play money and go and you start day trading stocks and everything else, that you still have that compound interest going on, getting those dividends, growing your account, and just not touching it, right? Like I have my foundation, I have the index fund, I have stocks that I just bought and hold and will never sell. And then I have my day trading stocks that I work with. So I think I highly recommend it to everybody. I mean,
I do too. Yeah. That's mostly what I'm invested in.
Yeah. So let's talk about the cost, right? Cost of mutual funds, index funds. Are the costs kind of the same? And what are the costs? What kind of goes into it?
So for most brokerages now, there isn't really a cost to buy into it. I know with stocks, a lot of brokerages are switching over to zero commission trading, but there's still a lot that charge you to buy into a stock and then sell out of a stock whenever you do a transaction. Mutual funds are a little different, where you can buy into it for the most part without any charge. You usually just have to have a minimum amount of money that you're putting into it. And then the brokerage will take out a certain percentage of profit that's pretty much built into the mutual fund itself. So for index funds, they're fairly cheap, since they're just following the market. There's no frills with it, so they'll usually charge you less than 0.05 annually. So that's pretty insignificant when the market can move up.
Much, right?
Like if the market moves up a percentage a day, like you don't feel any of that. Like you get a 90 or 0.95 profit, which is pretty much built into the fund itself, so you barely even notice it. So that's where people's IRAs and 401ks are usually built into, or made up of index funds, just because you're pretty much guaranteed to get a profit. There's no cost with it for the most part, and you're able to buy it, sell it long term without any cost of getting in or out of it. That's where select funds are a little bit different, where if you want to kind of bet in a certain industry like tech, and
Why
you
would
think that's
choose
going to
anything
make
else but tech right now? Right.
everything is tech. But yeah, if you want to bet on the tech industry that it's going to do better than an index fund, then it's worth buying into if you think that it's going to turn a bigger profit. The difference with that is the cost to buy in is still zero, but the percentage that the brokerages will take out will be a little bit bigger. So one that I'm invested in is Select Software and IT Services, and the expense ratio for that is a 0.72 rather than a 0.05 that you would find in an S&P index fund. But the reason that you would get that is because if you are a firm believer in a little bit of volatility and risk reward, and you think that it's going to turn a bigger profit than 0.67 over the index fund, which it usually does, then people are willing to buy into that. And
so you have to be
personally,
you have to be a future thinker, though, especially for that fund, right? To think how software and technology is going to kind of take over our world and how we automate things. And is that kind of where you went with that one, though?
And that's like one example of it too, where if, say, we'll go into like oil or something like that, if there's an oil select mutual fund that you can buy into now, it may not be as big of a profit for or like the beta might be half of what the index fund would do, but a lot of them may have bigger yields coming from it, so they may pay bigger dividends or more frequent dividends.
Is that because of it's a commodity, or is that just a one-off kind of fund?
It just depends.
Okay.
I think gold kind of does the same thing, where they know that it's not going to be fluctuating that much, but people want to buy into it because they'll give you a bigger dividend.
Right.
I think the most common one that people will buy into if they're getting a little bit older and they don't want to have much volatility in the market, they'll buy into select bond mutual funds, which will barely move, but they'll really just follow the bond index, and then pretty much give you a bigger dividend and interest compounding over time. So it's kind of you select how you want to make up your portfolio, the same way that we do certain stocks to kind of hedge our bets and diversify. You can do the same thing with mutual funds, where you want to buy into emerging markets, IT, index funds, and bonds. You have that option, and it gives you an even more diversified portfolio because it's made up of all these different stocks and bonds. So I think it's a good way to kind of set it and forget it without having to do too much research, other than just looking at the industry as a whole. And then it's just going to pay out a little bit better and be less volatile to the market over time.
Yeah.
So I highly recommend it, just because, I've been doing it for so long, and I got, money to just set and forget it, and I don't have all that free time.
Right. Well, that's a good point too. So this is more of a strategy for people that have like the 9-to-5 jobs, and maybe they have families that they need to take care of as well. Maybe they don't have the time to be focusing on the market so much. So this is a nice, just like set it, forget it, come back and look at it in 10 years, and just see what the gains are, right?
Pretty much. Or even if you need to reevaluate after a few months, like before the COVID epidemic, I'm sure a lot of people were wanting to sell out of their mutual funds, because if they had timed the market right, they would have been able to turn a huge profit.
Oh my gosh, man. Seriously. Anybody.
Everybody would have loved to do that.
That January return.
I know a lot of mutual funds will prevent you from rebuying into it for like 30 days. So that you don't do, you can't like do an active trader type thing. So you know how like stocks, there's like a day trade.
90-day thing that you just mentioned, right?
At least you have to like buy into it and hold it for 90 days. But if you sell it, I'm pretty sure that you can't buy back into it for another 30 days after that point, because they don't want somebody kind of taking advantage of the market. Like if you sell everything one day and then buy back into it the next day, then it kind of looks like you're an active trader and you should be in that mutual fund.
Gotcha.
So it's hedge fund managers that are, controlling these basically, and they don't like people touching things and
Yeah,
buying and selling whatever they want to.
It's the same way when you give, I think one of the brokerages, Webull or Robinhood or whoever it is, wants you to deposit your money. Like they run these promotions, right? Like we'll give you free shares of stock if you throw so much money in your account, but you have to leave it there for 30 to 60, 90 days, whatever it is. And so that they can take the funds, they can have their team invest it, make some profits off of it before you just go in and take the money back. So of course they need that time to be able to actually utilize the funds.
Right.
I get it.
And that's why and that's the same thing is why you can't sell it like in the middle of the day. So it'll only take the price at the end of the day for like whatever the, index is made up at that point. So they can at least get an idea of how many people are trying to buy into and sell out of it. But it's definitely not something that they can do actively for, every second of the day, because everybody would just be trying to sell and buy just like a mutual or just like a stock.
Which is not the point.
No.
Right.
That's why there's ETFs. There's that middle ground. You get
There's
the mutual
ETFs
fund that has everything.
Off of the funds
ETFs and stocks.
Yeah, I've seen that. The ETFs that literally, instead of tracking indexes, track the funds, the mutual funds now, and index funds. It's interesting.
Yeah.
So let's. Can you walk me through what front and back loads are when it comes to expenses of the funds, the mutual funds?
So it's kind of outdated at this point, thank God. But for a lot of brokerages, they used to offer, little or no cost expense ratio mutual funds. But the catch or caveat would be that you have to pay, $150 to buy into this mutual fund. So kind of like a commission. So
if I put $1,000 in, I was really only putting in $850.
Right. Like they would take it out of your account at that point. So a lot of people don't do that anymore. But there's always going to be a couple mutual funds that are usually for select industries or somebody that's kind of like a hedge fund manager where they're like, they have this surefire way that this is going to beat the market. They have a technical analysis key that no one's seen before.
Technical analysis.
But you have to pay me $500.
Right. Right.
So it kind of gives you that feeling like, oh, I'm being managed by somebody that knows what they're doing. This must be a good fund if I have to pay into it. So that's kind of where the front load
so just be aware of the front
from.
load, and then the back load is when you sell it, right?
Yeah. So some of them, if they don't have a front load, they'll potentially do a back load, which kind of encourages you to stay in the mutual fund a little bit longer. So if they don't charge you, that 150 whatever up front, you can buy into it all you want, but you're going to have to pay us to get out of it.
Yeah.
So that's like a little extra commission cost for these mutual fund brokerages that they like to throw at people to kind of foot in the door tactic, get people to buy in, but definitely have to pay if you're going to try to get out of it. So pretty outdated. You should be able to find mutual funds, whichever platform you're on, that don't have any fees associated with it, so that you can usually like narrow it down. I know on Fidelity, you can literally hit a checkbox that shows that there's no transaction fee. And most of their mutual funds are made up that same way. But I think across other platforms, it's pretty much in the same boat that if you don't want to have to pay to get into a mutual fund, there's a pretty good way to get out of it. So just be aware of that.
Gotcha. So here's the golden question. I buy into a mutual fund. How long should I hold it?
Over 90 days, because you have to. No, really, as long as, you're willing and able. So I think instead of monitoring it every day like you would a stock or ETF or anything like that, this is something that, you check up on when you notice that the market is doing something different. So, day-to-day activity, if you're in an index fund and the market maybe moves 0.05%, your mutual fund's pretty much going to do the same thing. There's not going to be any change.
Typical, not these 3 and 4% swings that we're having right now.
Exactly. Yeah. We'll get back to that at some point. But no, it's something that you just kind of want to hold on to, realize the gains for a long time and never really fully take out 100%. So instead of like having a checking or savings fund where you're just kind of sitting money and you're not going to be spending it for a long time, the savings account won't give you a huge percentage back. But if you're willing to kind of take a risk for a little bit and, get compound interest and a little bit bigger of a yield, with that extra risk, then this is something that, you know, it's good to hold on to and then sell out of it whenever, you know, you may need the funds available. So personally, I, you know, set mine and forget it for as long as I can. The only time that I really get out of my mutual fund is if I got, you know, paying tuition. So I got to take some money out for that, but I really try not to take anything out if I don't have to.
And when you take the money out, you still encounter taxes too, which I think people need to think about, right? Like, so you still have the short-term versus long-term capital gains tax, depending how long you held it.
Right. No, same aspect there. Usually you'll probably have to pay more taxes on it because if you have that much money going into it, then, you know, the returns are going to be greater, but you also have to pay bigger taxes. There's no way avoiding taxes, unfortunately.
The government wants theirs. That's what it is.
For real.
I know. Well, that's cool, man. I think there was one more question I had. Oh, here it is. So let's say beginning of the year, right? When January hit and the market started to take its turn, and of course you probably have, you know, a popular fund, right? Let's talk about like a Vanguard or an iShares, like popular S&P 500 tracking index fund. If people go in and they start running to cash out of the fund, does that affect my position in the fund at all?
No, it shouldn't. So this is kind of how it's different from stocks. So, you know, say Berkshire Hathaway is invested in Apple, and then they decide that they're going to sell 10% or something like that. That's going to have a huge impact on the stock. And, you know, you're going to see a big sellout and everything's going to go down after that.
Especially because it's Warren, but yeah.
Exactly. But if somebody were to do the same thing with a mutual fund, it's not a makeup of just one stock that is going to lose, you know, all these shares or whatever going back into the market. So if somebody were to sell that big of an amount, it shouldn't change it at all, especially for the amount of people that actually bought into these funds. You know, you picture, you know, Apple. I mean, that's a huge example, but let's say somebody smaller like Morgan Stanley stock, where, you know, you're less than $100 billion. If you sell out of that, then, you know, it'll have a bigger impact. But if you're at a mutual fund, you know, you're seeing hundreds of billions of dollars or trillions of dollars that are going into these funds.
Right.
Which, you know, the majority of the market, pretty much everybody's in some kind of index fund across the board.
Now, yeah.
And with the minimums too, you know, there's not really, you know, you can't just buy into it for $10. So it won't change the amount of shares. It won't change the price. It won't do anything like that. The mutual fund is always going to stay close to the index that it's, you know, trying to represent. So there's a lot less risk of, you know, a huge sell-off of a mutual fund. It's more of a risk that if there's a huge sell-off in the market that you're invested into, then the mutual fund is going to follow suit.
If not be the leading factor of it. I mean, that's, I think, one thing that people need to realize is that if you're looking across your watch list and you're seeing every single stock across the market falling, I mean, most likely it's because mutual funds or index funds, are pulling money out, and they do it in an even manner. So everything falls together in unison, just like, I mean, we never want to see it. But then also on the opposite side of things, like as we see money being put back to work right now, right? Like the index funds that have to get their returns every year are going back in, and when they dump money back into the market, it's spread out across so many stocks that the entire market just continues to rise. And so we're seeing the opposite effect. Right.
Yeah, you can't take the effect and make it the cost. Yeah, is like kind of how I put it. So, no, I fully see it the same way. Everybody's going to be invested in mutual funds forever.
Do you think so? You don't think they'll ever disappear?
No, they've been around, you know, as long as
there's not going to be like any index fund bubble or anything like that where people just.
I can't imagine. Some mutual funds may go away, and those are the ones that usually have like the front loaded or back end costs that go into it, because it's more people that are, you know, these hedge fund managers that may break it up or something like that, or they'll at least, you know, buy you out of whatever you have at that point and, you know, have you sell into something else. But there will never be a time At least in our lifetime, where a mutual fund is going to go, they're never going to go away. They'll always be around. Okay.
Well, cool. Thanks for all the information. I mean, all of that is just a crazy dump of mutual fund, index fund knowledge right here. Appreciate you giving us the time, as always. And I hope that everybody watching learned something. If you have any questions about mutual funds, index funds, leave them in the comments below. Either myself or Boomer can jump on, and we can try to help you answer those. If not, answer them in a future video. Hope you liked this episode. And actually, what's your social channels? Why don't people follow you on the socials?
Boomer 904 is most of what I got.
904 Duval. Represent Jacksonville.
904 represent Jacksonville, now Atlanta. Yeah, find me Boomer 904 on Instagram. I guess I'm on Twitter.
Twitter, man.
If you're gonna follow me on Twitter,
we tweet it up.
I
All
don't
the
do
information
anything.
that we get through Twitter, man. It's true.
I always like anything that you're just putting out on the Twitter. If you see one like on Dean Gatsby or Market Investor, you know it's gonna be me.
It's you. And I appreciate.
Also Venmo, Boomer 904.
Yeah.
Big plug on that. I don't ask for money, but I appreciate it.
$5 donations help pay college tuition.
Just ask your questions in Venmo, and I will get back to you.
That's a smart business model. I like that. That's why you're in business school. All right, man. Well, hey, everybody. I hope you enjoyed this. I hope you subscribe to this. It is something that we've enjoyed putting together. And if I guess without further ado, we'll see you in the next one.
See you guys. Thanks, Nat.
Why do you always do this?